It's Christmas week. Half the world is off, desks are empty, phones are on Do Not Disturb, and yet silver just ran into the $73 neighborhood. Not in a normal, busy, everybody saw it coming session, but in the kind of week where markets are supposed to sleepwalk. So the only question that matters is this: was that move a headline, or was it the market confessing something quietly because the room was empty? The Christmas squeeze. Why silver just hit $73 on a holiday? The why on a holiday? Question. When silver pushes record territory during a holiday window, you're not just watching price, you're watching market plumbing under stress, because Christmas week has a weird rule. If something breaks, it often breaks when nobody's looking. And silver has been leaving fingerprints all over the scene. Reuters reported silver pushing through the $70 barrier and setting fresh records into the holiday stretch. Then Christmas Eve comes early, close vibes, and MarketWatch noted silver touching $72.75 before easing back. MarketWatch. And the data feeds show that same 52-week high right there, 72.75. That's why people are calling it $73, because at that point, it's not about pennies, it's about the handle. So let me frame the entire video in one sentence. Silver didn't move on a holiday because traders got brave. Silver moved on a holiday because liquidity got thin and the market got honest. What the Christmas squeeze actually is: 4 layers. When people hear squeeze, they picture one thing: shorts panicking. But the Christmas squeeze is usually 4 squeezes stacked. The time squeeze. Markets aren't running full speed. Sessions are shortened. Participation drops. News is light, yet price swings can get violent because fewer orders are sitting on the book. The balance sheet squeeze. Year end is when banks and big desks tighten risk. They don't want surprise positions on December books, so liquidity providers step back exactly when the market needs them most. The logistics squeeze. Refiners, shippers, vault operations, real-world metal movement slows down around holidays. Even if metal exists, availability becomes time-sensitive. The truth squeeze end. Rumors hit harder when the room is empty. One big buyer can move price. One gap can trigger stops. One headline can become a stampede. And silver right now has the perfect conditions for all 4. Why this isn't just inflation? The structural backdrop. If this were only inflation, silver wouldn't behave like a supply chain asset. But Reuters has been blunt about what's sitting underneath this market. The silver market has been struggling to keep up with demand, with deficits highlighted by LSEG calculations, and silver being largely a byproduct of other metals makes supply hard to ramp quickly. Reuters also described how India, one of the biggest silver consumers, ran into shortages, with silver trading at large premiums during festival demand, alongside global deficits and constrained supply response. So here's the key mindset shift. Gold is a store of value story most days. Silver is increasingly a can you source it story. And that difference matters most during holiday windows, because holiday windows expose weak plumbing. The plumbing, London COMEX, and why where matters more than price. Let's talk about the part most people ignore. Silver is not one market. It's a chain of places, contracts, and promises. And sometimes the price spikes because one link gets tight, not because the whole world suddenly revalued the metal. Reuters reported that London, the biggest over-the-counter hub, has seen real moments of tightness, where spot pricing surged above COMEX futures and even made air freighting silver economically attractive. Now here's the detail that should make you sit up. Reuters noted that a huge portion of London Vault silver is tied up, about 83% allocated in one snapshot, meaning it's not freely floating inventory when the street needs it. So yes, silver can exist and still be hard to borrow, hard to move, hard to deliver. That's how you get a market that looks liquid on a phone screen, but behaves like a bottleneck in real life. And during Christmas week, bottlenecks scream louder. Why holiday weeks create fake calm and real volatility. Let me make this practical. On a normal week, you've got layers of liquidity: market makers, hedgers, arbitrage desks, miners, refiners, Industrial buyers. ETFs creating and redeeming on a holiday week, some of that disappears or goes half speed. So you get this illusion. Price looks stable until it isn't. Because when fewer people are quoting tight spreads, price jumps in chunks. That's why holiday moves are dangerous in both directions. A spike can be exaggerated upward by thin books. A pullback can be exaggerated downward when the holiday bid vanishes. So if you're watching silver tag $72, 75 inches, that environment, you don't shrug. You ask, who was buying size when nobody was supposed to be buying? The spark everyone is arguing about, Tesla plus 48 volts, without the hype. Now about the Tesla silver bomb rumor. I'm not going to sell you fan fiction, but I am going to explain why the rumor found oxygen. Tesla's own documentation is unusually direct that its 48 volts low voltage system carries increased risk of arcing or component damage if handled improperly. And Texas Instruments notes a very real engineering consequence of moving from 12 volts to 48 volts. Creepage and clearance requirements increase, impacting PCB layout, connectors, and more. Texas Instruments. So the rumor logic goes like this. 48 volts pushes tighter tolerances force higher reliability components, higher reliability switching. Contacts often lean on silver-based contact materials in certain applications. Even TE Connectivity discusses silver-based contact material families and their resistance to arc erosion, welding in relay contact contexts. Now, does that automatically mean 3 times more silver per car? No. And anyone claiming certainty is selling you something. But during Christmas week, you don't need certainty to move price. You just need a market that's already tight and a story that makes industrial buyers think. If this is even partly true, I don't want to be last in line. That's how a rumor becomes a procurement decision. So why did silver hit $73 on a holiday? The real answer, here's the clean answer. Because holidays are when the market is most sensitive to time. And silver, right now, is a time asset, not in the mystical sense, in the simple, brutal supply chain sense. If you're an industrial buyer planning for 2026, you don't care about perfect entries. You care about not missing delivery windows. So you see record prices into year end. Reuters framed this as a year-end rally environment in precious metals. Then you see the market push further on Christmas Eve. Thin participation, early close. And what happens? One of 2 forces usually dominates. Force A, holiday spike, paper-driven. Thin liquidity, headlines, stop runs, and fast money. Force B, holiday grab, physical-driven. Somebody is quietly securing metal, regardless of price, because the risk is availability. The Christmas squeeze is when Force B starts borrowing the volatility of Force A, meaning the paper move gives cover for real accumulation. The no best checklist. Is this a real squeeze or a holiday head fake? If you want this channel to be valuable, here's the part you can actually use. When silver rips into record highs on a holiday week, don't argue in comments. Run a checklist. 7 signals, 10 minutes. You'll know what kind of move you're watching. Signal 1, spot versus futures stress. Do you see persistent dislocations where certain venues trade hotter than others? Reuters has already documented periods where London spot pricing behaved unusually relative to COMEX. Signal 2, lease rates, borrowing costs. If borrowing physical metal stays elevated, that's not a meme. That's tightness. Reuters reported London lease rates at extraordinary levels during earlier squeezes. Signal 3, inventory draws, not just headlines. Watch exchange inventories like Shanghai Futures Exchange, mentions in Reuters context. When the market tightens, signal 4 ETF, subscription friction. When products can't easily source physical, you see weird steps like subscription suspensions. Reuters described Indian silver ETFs suspending subscriptions due to difficulty, cost of sourcing metal. Reuters, signal 5, real-world premiums. Not one screenshot, persistent premiums across regions. Reuters described India trading at notable premiums during shortage conditions. Signal 6, logistics behavior. Are traders doing things that are normally ridiculous? Like flying silver, an unusually bulky metal to plug a hole. Signal 7, the pullback character. A squeeze back move often pulls back differently. It doesn't calmly fade. It whipsaws, then rebids, because physical buyers use dips, not dreams. 3 scenarios for the next window, and what would confirm each? Now, let's map the next move without pretending we're prophets. Scenario 1. Holiday pop January reality check. Price cools as liquidity returns, and the market tests whether buyers are real or just emotional. What confirms it? Least stress eases. Premiums fade. Volatility drops. Scenario 2. Holiday pop year-end chase new highs. If liquidity returns and price still holds the high zone, that tells you demand wasn't just holiday air. What confirms it? Strong rebounds on dips. Tight spreads don't fully normalize. Inventories keep shrinking. Scenario 3. The gap. This is the one that scares people. Price pauses, then reopens after the holiday with an abrupt repricing because somebody couldn't wait. What confirms it? Overnight moves that don't get sold. Delivery chatter, persistent venue dislocations. And notice, none of those require you to believe in one rumor. They only require you to watch the plumbing. What you do with this practical, not preachy. Quick reality check. This is not financial advice. I'm not telling you what to buy. I'm telling you how not to get played by holiday price action. If you're not in silver, don't let a Christmas candle bully you. Plan your entries. Scale, don't chase. If you're already in, your job is simple. Don't get shaken out by holiday volatility if your thesis is supply and availability. If you're trading, holiday liquidity punishes tight stops. Size down. Widen logic. Respect gaps. If you care about physical, stop staring at the chart like it's the whole story. Your story is availability, delivery, and premiums, especially when the market is tight. So here's the verdict. Silver didn't hit $73 on a holiday because everybody suddenly became a genius. Silver hit the $73 neighborhood because the market is getting forced to price something. It hates pricing. Time. And when a market starts pricing time, it stops behaving like a normal commodity. It starts behaving like a strategic resource.